truly a regulator, talking to us about how we ought to think about regulation in the financial and securities markets. So, welcome Commissioner Peirce. I'm going to field questions for you. When you're going to talk for a while, we'll take some questions. I have to sort of translate them because our microphone doesn't work all that well. Thank you.
All right. Tom, thank you so much. I appreciate that kind introduction, and I'm so sorry that I can't be there with you in person, but it's a real honor to be part of this conference virtually. So I will say it's a little intimidating to give a talk about regulation in front of Professor Lambert, who's literally written a book on the subject. I picked up that book a few years ago, and you never know what to expect. The cover was nice, but you never know what to expect with a book on regulation. And I have to say that it really exceeded my expectations. It explains in a clear and compelling way the difficulties that regulators face when they wrestle with designing regulations that solve problems without creating bigger ones in the process. As the book explains, quote, regulation always involves trade-offs. The $64,000 question is how policymakers should proceed to ensure that they strike those trade-offs in a manner that creates as much social welfare as possible. Now that I'm a regulator, I will say that I appreciate the book even more because of the way it grapples with the difficulties of regulation. Because I am a regulator, I have to start out by telling you that the views that I represent today are my own, and they don't necessarily represent the views of my fellow commissioners or the Securities and Exchange Commission. Entrepreneurship and innovation don't have the happiest of relationships with regulation. Regulators get used to dealing with the existing players in an industry, and those players tend to have teams of people who are dedicated to dealing with regulators. Entrepreneurs, by contrast, trying to start something new are often much more focused on that something new than on dealing with what a regulator might think of what they're doing. Regulators, for their part, tend to be skeptical of change because its consequences are difficult to foresee, and figuring out how it fits into the existing regulatory framework is often quite difficult. Society, though, pushes regulators to deal with innovation. They have to accept change. After all, society benefits from entrepreneurs' imaginative approaches to solving problems and their willingness to go out on a limb to try something new. Society welcomes innovations that make people's lives easier, more enjoyable, and more productive. In many sectors, therefore, entrepreneurship and innovation evoke from the public overwhelmingly positive responses. In the financial industry, entrepreneurship and innovation don't always face such a positive, warm reception. Financial innovations, for example, were favored by some as the cause of the last financial crisis. Former Federal Reserve Chairman Paul Volcker, in a negative post-crisis appraisal of financial innovation, concluded that, quote, the most important financial innovation that I have seen in the past 20 years is the automatic teller machine. How many other innovations can you tell me of that have been as important to the individual as the automatic teller machine, which is actually more of a mechanical innovation than a financial one? I have found very little evidence that vast amounts of innovation in financial markets in recent years has had a visible effect on the productivity of the economy. Some people, though, might disagree with Chairman Volcker. Take, for example, the man who got stuck inside an ATM a couple years ago. In the course of repairing the machine, he got locked inside it. Without a cell phone or any other obvious way to communicate with the outside world, he was kind of stymied, so he came up with the idea to write a note on a little slip of paper and stick it out through the slot so that the customer coming to the machine, instead of getting a receipt, would get a little note saying, help me, I'm stuck inside this machine. Please get me out, call my boss. So one of the customers finally did that. He got rescued. But needless to say, he'll probably never look at an ATM the same way again. The moral of the story is that every innovation, even one that almost everyone agrees is good, carries some risk. Some people may get hurt by the innovation in ways we would never have imagined. Others may be helped by the innovation in ways that we would never have imagined. Some people will abuse the innovation in ways that we wish they wouldn't. We would be better off without some innovation. But we might not know until after time has passed what harm these innovations may cause. We also may not know the benefits. In other instances, we may not see the true full potential for innovation for many years. Technological progress in the financial industry offers that same mix of hope, promise, and risk that progress in other sectors of the economy offer. As regulators, therefore, we must allow innovations to proceed, even as we put in reasonable safeguards and watch for unanticipated consequences. The SEC's attitude toward innovation is particularly important because we regulate an industry that's effectively the gatekeeper for innovation in other parts of the economy. The United States has benefited particularly because our capital markets have been such an important part of the way that the economy is financed, much more important than it is in some other countries. So without funds that the capital markets provide, companies in other sectors of the economy wouldn't be able to explore new ideas and develop new products and processes. As a regulator, when I think about protecting the public, I think not only of protecting investors, but also of ensuring that the capital markets are able to serve the rest of the economy without undue barriers. Because of the central role the markets we regulate play in ensuring that the rest of the economy is funded, we need to be open to innovations that will make our capital markets function better and serve parts of the population that were not able previously to access those markets. For example, can we look for ways for unaccredited investors to pool their resources to invest in private companies? Can we change rules that mandate the use of outdated technology so that financial institutions can incorporate these cheaper methods into the services that they provide and thus lower the cost for their customers? Can we allow more experimentation in the way that funds and investment advisors communicate with their investors? Can we re-examine our assumptions about the types and methods of disclosure that we require in light of the enormous change in communications technology that has occurred since the federal securities laws were written in the 1930s? And can we permit more issuer communication with investors, which perhaps could open the door to a back and forth style of disclosures facilitated by online chats and message boards? These and other innovations in the capital markets often require regulatory approvals or regulatory forbearance. Both of these, my agency hasn't been particularly good about providing, or at least not speedy. The SEC now has a wonderful opportunity to consider its approach to innovation and entrepreneurship. We have just hired our first advocate for small business capital formation, Martha Miller. She brings a much-needed voice to an agency that has not been particularly open to thinking about the benefits that come from eliminating regulatory barriers to small issuers seeking capital. It's not, of course, the SEC's job to shift capital flows towards small and emerging businesses. Capital should flow to whatever business, large, medium, small, new, old, that can best use it. But we really do need to consider whether the rules that we have in place have the effect of putting a thumb on the scale in favor of large and established companies. Having someone at the SEC whose job it is to ensure that the Commission is aware of the types of difficulties that small companies face in our capital markets and in the regulatory framework is a particularly important step. Martha's enthusiasm, knowledge, and experience suit her very well for the job that she's stepped into. The agency's opportunity to rethink its approach to innovation also arises now out of a decade of technological development related to blockchain and cryptocurrencies. This area is challenging many regulators around the world, and the SEC is no exception to that. We, along with other regulators, are asking how our existing rules apply to this new space and whether a new regulatory framework might work better than the existing one. If we act appropriately, we can enable innovation in this new frontier to proceed without compromising the objectives of our securities laws, which are protecting investors, facilitating capital formation, and ensuring fair, orderly, and efficient markets. One of the things that makes regulating in this space challenging is that its very essence is decentralization. Decentralization is really not anything new. It's really at the root of our market system. Free markets draw on the talents and knowledge of people all across society to produce what society needs. No person or group of persons can serve as a central coordinator because doing so that person or persons would be inherently less smart and less plugged in than the market, which is composed of diverse individuals communicating with one another through the very brutal and blunt language of prices. Yet there's formal coordination too. Corporations, along with individuals, are key players in the market. By joining together through a corporate structure, people are able to combine their efforts and talents in ways that they wouldn't if they all worked on their own. Our securities markets have thus grown up around markets composed of individuals and corporations. Corporations issue securities, they make the attendant disclosures, and have other responsibilities under the securities laws. Our securities laws are designed with the assumption that every issuer has someone at the helm who can authoritatively disclose the relevant material information about the organization. Blockchain-based networks, though, offer a new way of coordinating human action that doesn't fit as neatly within our securities framework. Satoshi Nakamoto, in the white paper that introduced Bitcoin to the world, envisioned a, quote, network that is robust in its unstructured simplicity. Uncoordinated nodes work together toward a common end with little coordination. Other blockchain projects likewise seek to build networks that operate organically without any central organizer. Some projects seek to facilitate various forms of authentication, to replace traditional record-keeping transactions, or to allow individuals to interact with one another without using trusted intermediaries. The objective of many of these blockchain projects is to build networks that run on diffuse contributions rather than to create centralized entities that run networks. In the end, there may not be anyone at the helm of the ship. Yet many of these projects that we've seen begin in a very centralized manner that looks about the same as any other startup looks. A group of people get together to build something, and they need to find investors to fund their efforts, so they sell securities, sometimes called tokens. So in these cases, the SEC applies its existing securities laws, and that means that they have to be conducted in these offerings have to be conducted in accordance with our securities laws, or you have to find an exemption that you can rely on. When the tokens are not being sold as investment contracts, however, they're not securities at all. Tokens sold for use in a functioning network rather than as investment contracts fall outside the definition of the securities, which means they don't have to comply with our securities offering requirements. The Supreme Court's Howey test, which sprang from a dispute about Orange Grove 7 decades ago, is the tool that the SEC uses to distinguish between these two types of offerings. A case that was once only on the lips of law students is now the frequent topic of crypto conversations. In a now famous speech called When Howey Met Gary, the SEC's Director of Corporation Finance, Bill Hinman, explained how that case, along with another case called Gary Plastics, has informed the SEC's approach to digital assets. As Director Hinman noted in his speech, it's the nature of the transaction that determines whether an offering of securities has occurred, not the item being sold. The oranges in Howey were not securities standing on their own, nor were the groves in which those oranges grew. By contrast, the overall package sold to investors, the, quote, opportunity to contribute money and to share in the profits of a large citrus fruit enterprise managed and partly owned by third parties, end quote, was the securities offering, and therefore it triggered the federal securities laws. Purchasers' respective shares in this enterprise were evidenced by land sales contracts and warranty deeds, which served as a convenient method of determining the investor's eligible shares of profits. But the resulting transfer of rights to land was purely incidental. The key issue was the investment contract. So taking that logic, the Division of Corporation Finance looks to the nature of a token sale to determine whether a securities offering has occurred, and not just at the qualities of that token itself. Director Hinman went on to explain in his speech that because the token all by itself is not a security, just as the Orange Groves and Howie weren't, a token sold in a securities offering might later be sold in a transaction that does not constitute a securities offering. Once, quote, a network becomes truly decentralized, the ability to identify an issuer or promoter to make the requisite disclosure becomes less meaningful, and offers and sales of tokens are no longer subject to the securities laws. Director Hinman's speech has provided a useful framework within which people are analyzing their token offerings in connection with the securities laws. The staff is working on some supplemental guidance to help people think through whether their crypto fundraising efforts fit within the securities laws and how they might approach complying with the securities laws. There's also a standing offer for people to come in and get something called staff no action relief, which is you write in and you present the circumstances of what you're trying to do, and then the staff will tell you, okay, based on what you've told us, we're not going to recommend to the commission an enforcement action. And so that's one thing that people can do if they're uncertain of where they fit within the securities laws. They can come to us, to our staff, with that kind of a request. Of course, the commission itself has also spoken in this area, but we've done so through enforcement actions. And those enforcement actions necessarily involve a finding that there were securities at issue, that the tokens at issue were actually being sold as securities offerings. Enforcement actions are not my preferred method of providing expectations for people trying to figure out how they should raise money. It's regulation by enforcement is the concern that I have in this area. For this reason, I think it's important for the Commission, in conjunction with Congress and its fellow regulators, to offer something more concrete and carefully considered. The application of the Howey test does seem to generally make sense in this space, but we do need to tread carefully. Token offerings do not always map perfectly onto traditional securities offerings. For example, as a recent report from Coin Center noted, the decentralized nature of token offerings can mean that the capital raised through token sales may not be truly owned or controlled by a company. Functions traditionally conducted by people or groups of people designated as issuers or promoters under securities laws, which importantly bestow those roles with certain responsibilities and potential liabilities, may be performed by a number of unaffiliated people or by no one at all. Additionally, I'm worried that the application of the test will be overly broad. The Supreme Court in Howey embraced a, quote, flexible rather than static principle, one that is capable of adaptation. That's an unwelcome phrase for anyone looking for regulatory clarity. And the subsequent application of the Supreme Court's decision has further added to the ambiguity, and I would argue the breadth, of the test by diluting factors such as the prong that asks whether the investors were anticipating, quote, profits to come solely from the efforts of others. That solely word has gotten dropped in the application of this prong by courts. In the years since Howey, many courts have instead focused on whether profits are derived principally from the efforts of others. This approach has been formulated by one appellate court as a question of whether, quote, the efforts made by those other than the investor are undeniably significant ones, those essential managerial efforts which affect the failure or success of the enterprise. More to the point, the Commission itself has determined in 2017 in its now well-known Dow report that a decentralized organization based on a distributed ledger, the securities in that, the tokens that were offered were securities, is what that Dow report found, even though the token holders actually had responsibilities in that organization. Given the role that individuals play in some token environments, either through mining, providing development services, or other tasks, the SEC must take care not to cast the Howey net so wide that it swallows the efforts of others' prong entirely. In the realm of securities regulation, we often talk about the need for disclosure as a means of addressing information asymmetries between the issuers and their investors. The efforts of others prong in Howey is a way to get at this issue. If the investors are not in control of the enterprise, that is, if they lack material information about the operation of the organization, they'll need to obtain that information from those who are in control of the operation. And that's the only way that they can make an informed investment decision. It is possible that some projects may simply not be able to work under the existing Howey framework in a consequent application of the securities laws that flows from being determined to be a securities offering. One cryptocurrency project, Basis, has announced that it will shut down operations and return the $133 million it had raised due to the difficulty or impossibility, they argued, of complying with the securities regulations, given the team's vision for how the project would be conducted. I'm not going to comment on what I think about the merits of any particular project or how the securities laws might apply to any particular project, but my antennae will go up when apparently legitimate projects cannot proceed because they're concerned about the securities laws and they believe that they can't proceed in a way that's consistent with the securities laws. Ambiguity in this area, though, is not necessarily all bad. We might be able to draw clearer lines once we see more blockchain projects and see how they mature. So delay in drawing clear lines may actually allow more freedom for the technology to develop before we then write rules. Congress, of course, can get involved. They could resolve the ambiguities engendered by Howey by simply requiring that at least some digital assets be treated as a separate class. There's been a bill that has been put forward by Congressman Davidson and Congressman Soto. Recently, they introduced this bill, and it's intended to adjust the federal securities laws so that certain classes of tokens that operate in decentralized networks would actually be excluded from the typical treatment under the securities laws. Such an approach of treating digital assets as a separate asset class would allow for a more tailored approach to disclosure. In fact, some others have argued that whether or not ICOs fit within the definition of a securities offering, we should give some thought about how they should be regulated. There's a forthcoming paper, for example, from Georgetown law professor Chris Brummer with several co-authors, and they argue that ICOs have certain features that make the regulatory framework applicable to IPOs inappropriate for them. For example, changes to the blockchain may have outsized effects on certain tokens that depend on that blockchain. An investor may need to understand, for example, how the blockchain can be changed and how those changes would affect the relevant token before she could fully appreciate the risk that she was taking on and investing in that crypto asset. There's also the fact that much is irrelevant in terms of securities law. We call it material information about a token is often found in the white paper that the project sponsors issued. The terms of this paper may be highly technical and difficult for most investors to understand. Can you just get me that, please? Sorry, we've got a technical difficulty. So we talk about material information in the securities law context, and often this stuff appears in the white papers that are prepared for these crypto projects. Whether it's due to an honest error or not, sometimes these white papers are not 100% accurate to what actually is going on in the underlying code. And so there's been some concern about that, and there's been actually some work done to sort of compare what the code actually says with what the white paper says. And so people are starting to wonder, whether the two match up and starting to ask some questions. I think regulators hate to admit it, but we shouldn't assume that absent securities laws, there would be no disclosure at all. Professor Lambert himself notes in his book that the disclosure approach built into the securities laws is designed to, quote, prevent adverse selection by requiring informationally advantaged parties to share specified information with their counterparties. As he explains, however, even in the absence of government directives, the informationally advantaged party may not need the government to tell it to make disclosures. the market itself will send this message. Disclosure is a way to signal quality, something you want to do when you're trying to convince someone to buy your product and to trust you. So after an initial period of unbridled enthusiasm in the ICO context, we see that cooler heads are starting to prevail. People are starting to think about new ways to assess ICOs and to separate the wheat from the chaff. Sponsors of ICOs that want to succeed will make voluntary disclosures because they want to signal their quality. Disclosure will happen regardless of whether the securities disclosure regime that we implement and that we oversee applies to token offerings. Moreover, the platforms that trade cryptocurrencies can play a role in forcing such disclosures, much as stock exchanges did before the securities laws took effect. Our interactions with cryptocurrencies, of course, are not limited to the token offerings. The platforms themselves are something that we are also looking at and trying to think about how our securities laws should apply to the platforms that trade these tokens. Some of them are looking to register with us, and I'm eager to work with those exchanges to address the outstanding difficulties in the way that our rules apply to them. Again, we may need to make some accommodations because these platforms are not exactly like platforms that trade other types of securities. There's also great interest in exchange-traded products based on Bitcoin and other cryptocurrencies. As I've mentioned in the past, I'm concerned that our approach with respect to such products borders on merit regulation, where we're deciding something is or is not good for investors. My preference is to allow investors to make that decision for themselves, make sure that they get the information they need, and then allow them to make their own decisions. We do rightfully fault investors for jumping blindly at anything that is labeled crypto, but I think sometimes we jump blindly away from anything labeled crypto, so we should be careful about our impulsive approach in that space. I'd like to conclude by drawing again from Professor Lambert's book. His definition of regulation really struck me. He describes it as any threat-backed government directive aimed at fixing a defect in private ordering. That really reminds us of the gravity of the regulator's task. Private ordering is the baseline because, as the book explains, quote, when property rights are well-defined and transferable and individuals are able to strike trustworthy exchange agreements, markets will emerge and channel resources to the production of goods and services that individuals value most. So regulation involves actually overruling private arrangements, substituting a government mandate, and then imposing a penalty of some kind on people who fail to comply with that mandate. Given the potential consequences of doing these things, the regulator and the people on behalf of whom it regulates must think carefully about whether and how regulation should be employed. That careful thinking, however, may mean frustration for the innovators hoping for quick answers about what relevant regulations are. I want you to channel that frustration by coming and talking to us about how you think we should approach these regulatory questions. Sometimes I feel like that repairman and the ATM machine sending little clips of paper to the outside saying, come help me. I would love to have people come and talk to me about how we can make our regulations better so that entrepreneurs can really focus their efforts on providing better products and services and really revolutionizing the way that we interact with one another, which is what I think is the potential of this new blockchain and crypto technology. So thank you all, and I'm sorry again for the unconventional break in the middle, but I hope that means that you all have some good questions, and I look forward to hearing your thoughts.
During the break, we settled on how we were going to do the questions. So we have an on-deck chair here.
All right.
If you've got a question, come up and get in the on-deck chair. But I will lead us off. And one of the things I want to talk about was really not about cryptocurrencies, all, I'm very happy that you talked about that because the ICO thing is obviously a topic that lots of people are interested in. But one of the things that I've noticed with the securities laws and the SEC as an agency is that there has been a move, it seems, since really the Enron WorldCom debacles, away from the mission of correcting information asymmetry and toward encouraging certain types of corporate governance, using the securities laws to do that. So, some of this predated Enron and WorldCom, but there's Rule 14.8, which is the rule that allows for shareholders to vote on all sorts of proposals. So it involves some sort of shareholder democracy in corporations. There are the exchange listing rules that were adopted in large part at the behest of the SEC on director independence, et cetera. And then there are certain securities rules that have been put in place as sort of a name and shame strategy. So the conflict minerals rule and the pay equity rule, corporations are having to disclose information, and it seems really not like information that investors would really care about, but it seems like the goal behind those rules is to discourage certain types of managerial decisions. So I wonder if you could comment on what you think about the role of the securities laws and the SEC as an agency in encouraging certain types of corporate governance.
Well, I agree with you that I think the core role of the securities laws is to get disclosure to people and address those information asymmetries. And some of what we've been asked to do recently by Congress and then by other folks who are pushing Congress and pushing us is to take a much more activist role. Now, to the extent that Congress has told us to do something, I, as a regulator, am required to do it. So I will say, though, that if someone comes to me and asks me, should we use the securities laws to achieve these objectives, to make sure companies are all governed in a way that a uniform way that we think is right, I would say no, because I think it's very difficult to craft one-size solutions that fit for every company. So I would like to see as much freedom as we can have for companies to be organized the way they want to be, as long as they tell people. They have to be upfront, tell people what the organizational framework is, and then that's fine. In terms of some of the stuff that's been added recently, for example, Dodd-Frank, you mentioned a couple of the Dodd-Frank mandates that really are very far outside what one would normally think of as the securities laws, so things like requiring conflict minerals disclosure, requiring pay ratio disclosure. I think one unfortunate thing that led to that is that people said, well, and it's actually a fortunate thing, which the securities laws work really well, and people said, hey, wow, there's this great securities law framework out there that works really effectively, so how can we bootstrap that and use it for our purposes, which are not at all related to securities offerings or to investors or markets, but we can use this existing framework and we can get it to achieve our social objectives. And again, I mean, to the extent Congress tells us to do something, we have to do it, but I do worry that what happens then is that we lose sight of the real objective, which is making our capital markets function as effectively as they can by making sure that information is flowing from the people who have it to the people who need it to make their investment decisions, and making sure that the markets are operating. So when we're asked to do other things, then our attention is focused on those other things, and we can't focus on the bread and butter, the basic pieces of our regulatory framework that need updating and need, that maybe we're seeing issues that we need to address. So I do really get concerned when we're asked to take on new obligations.
So on deck is the editor-in-chief of the journal, the Business Entrepreneurship and Tax Law Review, that's sponsoring this
Oh, thank you for sponsoring.
No, thank you for talking. So you talked a lot about cryptocurrency and initial coin offerings, so I figured I would take the bait. I know in initial public offerings, people seem to draw a connection because the IPO, ICO, they sound very similar. But in the IPO world, it's you're issuing stock usually, and the company uses that to raise money. On the ICO side, I know there was a report issued by Ernst & Young last year that said about 90% of ICOs were selling utility tokens, and they were designed to sell the pre-purchase of a blockchain service, not traditional investment contracts as we've been known to see them in the market. I know in those situations you have the company is obviously looking to raise money as an IPO company would, but the customer is looking to just buy access to a product later down the road. I'm curious from your perspective, I know you can't speak to the SEC directly, but would you side more on the company's side where they are seeking to raise money by issuing something and we're going to say that's a security, or do you err more on the customer side and say they're just looking at this as a pre-purchase of services that is not an investment contract?
Well, I mean, you hit the nail on the head in terms of what the central question is in this area. It is drawing those lines, and those are difficult lines to draw. And so as you'll hear from any securities lawyer, the facts and circumstances based question. But, if people are essentially raising money for a project and using the tokens are essentially just a representation of an investment contract, we will regulate it as we would any other securities offering. I think the question is, a lot of these networks are pre-functional when the money is being raised, which is understandable. I mean, they're trying to build out a network. So because of that, it becomes difficult. And a lot of people who are buying, I ran into a kid in the grocery store the other day, and he and I struck up a conversation, and he asked me, I told him I was a securities regulator, and he was excited because he said, well, I'm a crypto investor. And I asked him what he had invested in, and he told me the name, and I said, well, tell me about that particular project. And he said, I know nothing about it. All I know is I saw something on a chat board about it, in a chat room about it, and they said it was going to go up, and so I bought it, and I made a lot of money. And so, he said, I realized that's probably not how I should make investment decisions. And I said, yeah, that's right. You shouldn't. You should do some research. But I think because there are a lot of people in that category who are buying into tokens with really little interest in the project and more interest in, hey, I'm going to make a lot of money, it makes it look a lot more like an investment contract to us. So again, all of these factors, we're trying to figure out how they all play and relate to the Howey test, which I talked about. And so that's really that's the question that we're struggling with. And then if something starts out as a security, does it then transition and later, no, this really is a utility token? So I think that's where I'd love to have input from people who are involved in these projects and have suggestions about where we can draw these lines in a way that's not going to squelch the innovation, but that will also treat something that is actually a securities offering as a securities offering.
Anybody want to jump in? The queue is empty. I'll jump in unless a student wants to jump in. So you're getting another professor, Gus Horowitz from the University of Nebraska. Many questions. Stick with a cryptocurrency-related one. I do telecommunications, internet, cybersecurity-related stuff. I'll note Bitcoin, I think, is up about 8% today. Ethereum is currently up 15%, and Litecoin is up 30% today. So apparently these markets are booming again, back to 2017 or something. The question that I have is, we are in an increasingly globalized world generally,
and cryptocurrencies are not tied to any specific geography. So how do you think about regulating an asset, a security that isn't tied to a specific geography? And in particular, I'm sure you speak to plenty of folks from the tech world about this, who frequently have the perspective of, so what? The SEC wants us to behave differently. We're just going to move our money from Bitcoin to Bitcoin Cash to Litecoin to Zcash, and we'll cash out in the end in Singapore or China.
Well, I mean, I think that is certainly a challenge of our modern world, is the ability to transcend borders, and I think it's an issue that is difficult for both us and for states. You know, determining where a securities offering is made is a difficult question, but I think we can apply some of the same rules that we've applied in other contexts, and you know, I think we should be consistent. So to the extent we can figure out whether people are U.S. investors, then you know, we can apply our framework. And sure, there'll always be people who try to avoid the reach of our securities laws, and I understand, you know, there's also just a confusion about how to comply. And so I think if we took the step of providing better guidance, people would be more willing to use the securities law framework, seeing that it actually could work. And I think that it would save everyone a lot of pain. You know, people wouldn't have to worry about whether they were in compliance, and we would have a much better sight on some of these markets.
Hello, thank you again for coming. So I teach evidence in 4th, 5th, 6th, outside my area of expertise, but I heard a very interesting debate, now I can go right to the source, about whether insider trading ought to be against the law. And you know, whether there's really a victim. I understand, you know, of course, if Congress tells you it's a crime, then so it is. But if Microsoft wants to announce that we're the kind of company where directors and employees are allowed to trade based on insider information, and therefore we're probably going to be making a lot of smart decisions, maybe you should invest in us, do you think that ought to be allowed?
Well, I mean, we have securities laws that have been in place for quite a long time, and insider trading has been something that's been prohibited for insider trading. There's certain categories of insider trading that are fine, but insider trading in certain circumstances is something that we don't permit. One could make an argument. Henry Manny made many arguments about why that wasn't the best approach, and I think those are issues that are above my pay grade. That's Congress's call. But you know, I think that what we could do, and what some of the recent insider trading case law has suggested, is we could do a better job in providing some clear parameters. So some people have suggested that you would actually have a statute on the books defining what prohibited insider trading is. So that's one approach. One of my colleagues has talked about that as a potential approach. So I think that would allow for a broader conversation about what we do and don't think is appropriate to permit. Again, you know, there are different approaches to take, and the approach that we've taken in the United States is to say that we want to have this blanket prohibition and not allow companies the choice to do that. And so that's kind of where we are now. But you know, people write. In fact, I think Professor Lambert has written on insider trading, so he may actually be a better person to ask this question.
Thank you.
We got a student coming.
Former student.
Oh, former student.
Hi, I'm Bobby Bennett, very recent graduate of Mizzou Law and general finance nerd. Congratulations on your first year. It's been a very hectic year, as we remember in the last January with the great Bitcoin crash and the emergence of various investment vehicles. Increasingly, we see the volatility indexes, ETFs, and robo-advisors playing an increasing role in the marketplace. However, there's increasing concerns about how these can be abused and possibly increase market volatility, especially with the robo-advisors potentially causing fluctuations and profiting off them. And as we experience increasing innovations in the marketplace, how does the SEC, adapt to these rapid changes in a way that protects investors as well as the economy as a whole?
So I'm not sure I got that whole question. Can you succinctly repeat it?
Sure.
It was just breaking up a little bit.
Yeah, with the with the rapid changes to how trading is being done with new investment vehicles and new methods, how is the SEC able to react to these rapidly changing methods in a way that protects investors and the economy as a whole?
Well, I mean, I think it is a challenge for us. I think regulators just tend not to be very nimble, and that's partly intentional because you want to have procedures in place to make sure that when you change rules, people have a chance to give input and have a chance to say, no, this won't work. Yes, this will work. Maybe you should do this instead. So some of that is intentional, but it does make it difficult to deal with emerging technology. Now, I think one thing that we should keep in mind is that to the extent we can write our rules in a flexible, principles-based manner that allows for variety, it should better allow for some of the technological change to happen without us needing to change our rules. And I think that the securities laws have been quite effective at adapting over time. So, I think that's positive, but we have a real need to get information from outside, to have people helping us as we deal with trying to fit our regulatory framework to a world that changes very fast. And so I would say the best thing that we can do is have better communication with folks from the outside. And that is something that, in the crypto space, for example, we've really made a concerted effort to say, come talk to us. We have people here who really do understand the technology. And I think that's a start. We definitely could use more of those kinds of people here. But I think that is positive.
Thank you.
We got time for one more question.
All right. So my question's switching gears a little bit, but I know another recent securities regulation focus has been on protecting elderly investors. And so my question's regarding recent regulation. I know there's a FINRA rule and states have been passing regulation that lets a broker-dealer put a hold on securities or on a disbursement of securities if they believe there's financial exploitation. And I'm kind of torn on this because on one hand I see like that can obviously protect the investor, but also has the potential to just kind of stop them from making the transaction that they're voluntarily making. Like maybe they are educated and either their investment advisor or broker's like, no, this doesn't look good, I'm going to stop it. And I was just wondering how that kind of, how you think that, how that just kind of, sorry.
No, I think that's a great question. I think that this issue of elder fraud in connection with investments is a real issue. We see it all the time on our enforcement docket, where people take advantage of folks who are older and have diminished capacity. And so it's something that a lot of people have been thinking about. You're right, FINRA is essentially it's a non-governmental regulator in this space, and so it regulates brokers, and so it's the frontline regulator for brokers, and then we regulate FINRA. So FINRA has been thinking about this issue along with people in the state and people at the SEC. And I think you point out exactly the issue. On the one hand, we want to make sure that people are protected, but on the other, you don't want to say just because you're old doesn't mean you can't make your own investment decisions anymore. And so it's a very difficult line. And you want people who are financial professionals who are dealing with older investors to be on the alert if they see something strange going on, but at the same time, you don't want it to be too invasive. So I think it's an area where we're spending more time thinking about it and trying to get that balance right. But I think you painted it exactly correctly in your question. It's not actually that easy of a problem to solve. So if you have great ideas on it, we welcome it.
Thank you.
Well, thank you so much, Commissioner Peirce, for talking to us today. We realize that you've been a victim of this shutdown for a while and lost your staff, some of your staff, at the time when you would be preparing your remarks. So we're very thankful that you were able to join us electronically, and you've given us lots to think about. So we will certainly be watching the cryptocurrency space. And the ICO.
Thank you so much. I appreciate the chance to be with you. Thank you.
Thank you.